review the yield curve dynamics. So you want to remember that all debt, all equity, all debt and equity, along with real estate, and derivatives are priced off the yield curve. And the yield curve in those cases is upward sloping. It is the yield to maturity on U.S. government treasury securities. It can also be the swap curve, the euro curve, the Japanese curve. So it's the sovereign bonds are considered risk-free, particularly in the United States, because the Federal Reserve can print money to pay the coupon in the principal on the bonds when they come due. So you have interest rates for each maturity. This could be a 1 month, 3 month, 9 month, 1 year, 5 year, 7 year, 10 year, 20 year, or 30 year bond. The curve is upward sloping because of inflation expectations. So by using the Fisher equation, which is the real rate of return plus the inflation expectations. So I'm a bond buyer, I'm an investor. When I buy a bond, I'm basically lending the government money. Well, to compensate for the deterioration in the purchasing power of my coupons that I'm receiving and the principal in the future, I want to be compensated for the erosion in my purchasing power through some type of inflation expectation, some kind of inflation premium tacked on. So the further out you go, the higher the inflation premium to compensate for the erosion in purchasing power due to inflation. Because the coupon that I get on the bond is not indexed to inflation, and the premium, the principal that I get back in the future is also not indexed to inflation, so it's subjected to the erosion of the purchasing power due to inflation. The bonds on the short end, in here, bonds 1 year with maturities less than 1 year is considered the money market. And bonds greater than 1 year are considered the capital market. And stocks are also considered part of the capital market. The curves are also segmented by medium term and long-term bonds. Most of the market is not made up of 30-year and 20-year bonds. The majority of the market is made up of bonds with maturities less than 10 years. And the 10-year bond is the index bond, is the index interest rate, the index interest rate. So all commercial and residential mortgages, along with other loans, are priced off of the 10-year treasury because it takes into consideration the inflation expectations. Now the yield curve can shift down. The yield curve can shift up. Interest rates along the curve are also considered the risk-free rate. Risk-free rate. So if the yield curve shifts up, then bond prices go down. If the yield curve shifts down, then bond prices go up. If the yield curve shifts up, the cost of capital goes up. And if the yield curve shifts down, the cost of capital goes down. The three theories, the three types of yield curves, is one is upward sloping or normal. The other is flat, and the other is inverted. With a normal curve, inflation expectations are positive. In a flat curve, the inflation expectations are 0. And in an inverted curve, the inflation expectations are negative. Because the view is that the economy is going to be growing in the future, generating higher aggregate demand, putting upward pressure on prices. In an inverted curve, the future is looking towards a recession and falling prices and negative inflation expectations. So the curves, when inflation expectations start to rise, or inflation starts to rise in the short run, the Federal Reserve will start to sell bonds, driving bond prices down and interest rates up. So when they start to see the economy overheating, they're going to sell bonds. It's going to cause the curve to flatten, and interest rates are going to go up as bond prices go down. Now, the Federal Reserve, a lot of times, sees asset price bubbles in stock markets, and also sees building of inflation in the economy. Therefore, they will start to sell off even more bonds, and in most cases they overshoot and sell too many, which drives bond prices down even further and interest rates even higher, to the point where short-term interest rates are higher than long-term interest rates. At this point, when the curve inverts, the stock market peaks in 12 months, and we are in a recession in 24. There's three theories. The expectations hypothesis basically is the Fisher equation that states that yield curves are upward sloping because of future inflation expectations. Okay. The other theory is the preferred habitat and market segmentation. That basically states that there are different borrowers, lenders, bonds, different types of investors in bonds, based on maturity. So corporations like to borrow and invest, particularly because of inventories, on the short end of the yield curve. When they're financing equipment, they're using medium-term bonds, and pension funds want to invest on the long end because their pension liabilities are coming due 10, 20, 30 years in the future, and they can match the maturities of their pension liabilities. So they prefer to be out here on the long end. Insurance companies are out here. They borrow long and they invest long. Corporations are here, but longer term, plant and equipment, and then inventories are here. It's cheaper to borrow on the short end than the long end. The problem is if you borrowed on the short end, and your bonds are coming due every 1 month, 3 months, 9 months, you have reinvestment risk. And if the curve starts to invert, you could get negative leverage and negative arbitrage. Where actually your borrowing costs are higher than the rates of return on your investments. So the inversion of the curve is extremely dangerous for corporations. The curve can flatten. I mean, it's flatten and invert because of higher inflation expectations. But also the curve can flatten and invert of the Treasury and the Federal Reserve and foreigners selling too many bonds, where there's too much supply of bonds, particularly on the short end. That's the biggest risk right now in the marketplace, is a liquidation of short-term Treasury securities along with corporates that could flood the market and cause the curve to flatten and invert and create a recession. So the yield curve is extremely important. And because of the dynamics of the yield curve, it determines the expected returns on assets and also the cost of capital for companies. So when you're building a discount rate, the cost of the debt, or the expected return on the debt. Remember that your corporation, your cost of debt is the expected return on the debt by the investor. It's the same thing. So your cost of your debt is going to start with the risk-free rate, and you're going to start tacking on risk premiums. Credit default, illiquidity, maturity, maybe inflation or currency. There could even be tax, and you start adding on the risk premiums. So obviously, if the yield curve is flattening and inverting or shifting up, then the risk-free rate is going to go up, and your cost of debt is going to go up. Risk-free rate shifts down or flattens and turns normal, then your cost of the debt is going to go down, holding all the other risk premiums constant. And these risk premiums will widen and narrow over time. During the financial crisis, these and these blew out. These went down, but these went up significantly. Maturity was pretty much fixed. There was some currency, but that was pretty fixed. And then tax risk premiums didn't come into until 2013. And now we're hearing about tax risk premiums because we don't know what the administration is going to do along with Congress for personal, corporate, and real estate. So the cost of the equity you're going to use the capital asset pricing. The cost of the equity is going to be equal to the risk-free rate plus the beta times the return on the market minus the risk-free rate. So obviously, if the curve flattens and inverts or shifts up, the risk-free rate is going to go up and the cost of the equity is going to go up. If it shifts down, then the cost of the equity is going to go down. If the beta goes up, the cost of the equity goes up. If the beta goes down, the cost of the equity goes down. If the expected return on the market goes up, the cost of the equity goes up. If the expected return on the market goes down, the equity goes down. Okay? Then you take these two to calculate your weighted average cost of capital, or your WACC. You know, these are both discount rates. If you're going to price the bonds, you use the cost of the debt. If you use the equity, you're trying to price the stock, you use the CAPM. And if you're using capital budgeting, you're using a discount rate, trying to come to a discount rate. For capital budgeting for the firm, you're going to use the weighted average cost of capital. So the WACC is basically the weight of the equity, times the cost of the equity, plus the weight of the debt, times the cost of the debt, times 1 minus the tax rate, because as of today, we can still deduct the interest on the bonds. Okay, so that then becomes your WACC. Okay, and then obviously you're looking for a what? IRR minus the WACC. It's going to give you some positive spread. And in most cases, it's about 100 to 125 and maybe higher basis point spread. And you can multiply this by the assets, you can multiply this by the liabilities to get the dollar amount of the IRR minus the dollar amount WACC, and this is going to give you economic value add, or EVA. Okay. And if these are book, right? These are book values. If we use market values for those, we're going to get market value add, or MVA. Okay. So corporations are monitoring this. This is basically profitability on the margin, okay, in the benchmarks that they're using. So this flows right into the asset prices. So if we're going to value bonds, we can assume, let's just assume a perpetuity bond or a preferred bond, instead of a discount of the cash flows. But remember that when you're valuing bonds, that if you have a bond with a 10-year maturity, and the coupons are paid biannually, then you have 20 payments that you need to discount, as opposed to a 5-year bond biannually paid with 10 compounding periods. So the longer the bond, the more sensitive the bond price is to movements in interest rates. Right? It's the duration or the convexity, right, of the bond. So duration is really the price elasticity of the bond movements compared to movements in the interest rates. Okay, but I'm not going to go into that. And so when you're valuing the bond, let's say you have a coupon that's fixed, you got the expected return on the debt, or the cost of the debt, you're going to get the value of the bond. So again, if risk-free rates go up, then the bond prices go down. If risk-free rates go down, the bond prices go up. If you're looking at stock, obviously it's the dividends, or it's earnings per share, or it's FFO per share, or it's net operating income per share, whatever it is that you're using. It's going to be divided by some expected return or some cost of the equity. It's going to give you the value of the equity. So obviously, if risk-free rates go up, the value goes down. If risk-free rates go down, the value goes up. if you use and this is the perpetuity model, if you look at the Gordon growth model, it's going to be D divided by I minus G. This is going to be your cost of the equity. And this is going to be the value of the equity. So if the risk-free rate goes up, the value goes down. If the risk-free rate goes down, the value goes up. The expected growth rate in the dividends or the EPS or the free cash flow or whatever it is goes up, the value goes up. And if the expectations are going down, then the value goes down. If you're using the multiple approach, you can use the earnings per share for next year times the multiple, T+1 equals the value of the equity, T+1. So if earnings per share expectations go up, the value goes up. If the earnings per share expectations go down, the value goes down. If the multiple goes up, the value goes up. If the multiple goes down, the value goes down.
So what is the multiple?
That's what I'm going to show right now.
Oh.
Okay? I just wanted to show the relationship first. So there's multiple methods in calculating the multiples. You could use forward-looking price to earnings, T+1, price to earnings ratios, or you could use 1 divided by IE. It's going to give you a multiple, and 1 divided by I minus G is also going to give you a multiple. If the risk-free rate goes up, the multiple goes down and the value goes down. If the risk-free rate goes down, the multiple goes up and the values go up. Same thing in the, this is basically the Gordon growth model, but you're basically converting this into a multiple. And then again, if G goes up, this goes up, that goes up, G goes down, that goes down, this goes down. So basically the yield curve has a direct impact on the discount rate determination and asset price intrinsic valuations. And the movement in the yield curve, particularly on the short end, is all driven by monetary policy. Through open market operations. So the Federal Reserve controls the short end of the yield curve, which is also called the term structure of interest rates. The term structure of interest rates basically say, we're going to take the geometric average of the interest rates and extrapolate future interest rates through the geometric means. So the Fed controls this. So when you see a normal to flat to inverted and back, it's the Federal Reserve. It's basically doing that to try to regulate capital in the capital markets by buying and selling bonds to drive bond prices up and down, interest rates up and down to either cool the economy or stimulate it. So it's the Federal Reserve at the end of the day that has the impact on all asset prices. Gold, oil, bonds, stocks, derivatives. Did you want to take a picture of this or anything? No? Okay. You can stop it and then start it again.